All right, so in this video, I'm going to talk a little bit about valuing a stock that pays dividends, but with varying growth rates. So basically, what we're going to do with a stock that pays dividends but has varying growth rates is that we're going to essentially use the different growth rates that we're expecting over the next perhaps several years. And we're going to assume that at some point the growth does become constant eventually. So we're going to have a series or potentially a series of different growth rates initially, and then eventually it's going to turn into a growth rate that is stable thereafter. So in the equation that I have on this slide, D1, D2, DN, those are all the subsequent dividends. So D1 would be the dividend at the end of the first year, D2 the dividend at the end of the second year, and so forth, all the way up to DN, however many years in the future that is. And DN is going to be the point at which the stock we're going to assume is going to transition from whatever has been going on in terms of growth to something that's a stable growth rate from there on out. So basically what you can kind of view this as is a stock that's growing at one rate of growth or perhaps even multiple different rates of growth for a length of time, followed by eventually becoming constant at some rate that continues on indefinitely. So this term here at the end is basically finding the value of dn plus 1. So basically, dn plus 1 would be the dividend 1 year in the future. And the way it does that is it takes dn times 1 plus whatever this gc is. Gc is the rate of constant growth that we are assuming the dividend is going to have after n years. So basically what's going to happen is it's going to grow at one rate or perhaps multiple rates up through year n. And then after year n, basically what's going to happen is it's going to grow at some other constant rate thereafter. And that's going to be GC. So RS is still our required rate of return on equity. So that's nothing particularly new. So really, if you think about this first term, it's finding the present value of D1 because I have a future value of D1 over 1 plus a rate raised to the 1. So this is the present value of D1, which means this term is the present value of D2. And I keep going on and on and on until I get to DN. And now I'm finding the present value of dn. And then this finds the present value of all dividends from year n plus 1 and beyond as of point in time n, wherever that is. So if I drew out a timeline, I would have all the different years, and then I would get to n, and then n plus 1. So basically, at point n, we're doing this calculation here to find the value of everything after year n at that point. Well, if I find the value of everything after year n at point in time n, then I need to actually bring that back in terms of present value to find the value at time 0. So I take the value of all those dividends from year n plus 1 and beyond, and the value at point in time n. So this finds the present value of everything after n at point n. And then you divide it by 1 plus rs to the n. And that means that I now have found the value at time 0 of all of the dividends from n plus 1 and beyond for all eternity. Okay. Now, if you're thinking, well, this is perhaps a little bit confusing, well, let's kind of add a little bit more details to it. So let's think about how we would actually implement this. So we're going to start down here. We're going to assume D0 is essentially what we assume they paid yesterday. So I know what D0 is because they paid that yesterday. And the idea is we have some growth rate that continues on for that first year. So if I have some growth rate that continues on for the first year, then or at least I'm projecting some growth rate. I'm going to take 1 plus that projected growth rate times whatever the dividend was yesterday. And that's going to give me D1. Well, once I have D1, I could take D1 times whatever growth I am projecting for year 2, and that would get me my dividend for year 2. And then I would take D2 times whatever growth I'm projecting for year 3. So D2 times 1 plus the growth for year 3 to get D3. And so basically, once you do that, you kind of work your way forward to find the different dividends. You keep going until you get point in time n. N is whatever point in time the stock transitions from the rate of growth that has been going on to a constant rate of growth that lasts for all eternity. So let's suppose that we have a stock that's going to grow at 20% for the next 4 years, and then it's going to grow at 5% thereafter for all time. Well, if that's the case, then I would use 20% for G1, 20% for G2, 20% for G3, 20% for G4, and I would use, then start plugging these in and working out the numbers. So D0 times 1 plus 0.2 to get to D1, D1 times 1 plus 0.2 to get to D2, and so on. And so I would find those and I'd plug those in, and I would get to dn, whatever that number is, over 1 plus rs to the n, which would be 4 in this example. Then I would find if it's going to grow at 5% thereafter, I'd take that dn times 1 plus, I think I said it was 5% thereafter, so 1 plus 0.05. And that's going to give me my D as of year n plus 1. In other words, 1 year beyond. So I'm going to find whatever that number is, divide that by RS minus GC. The G here would be the 0.05 in my little example. RS would be whatever my required rate of return is. This term would then find the value of all dividends after point in time n, as of point in time n. So let me use some numbers here. So in my example, if I said it's going to grow at 20% for 4 years, n is going to be 4. So I'd have a D1, D2, D3, D4. Then I would find D5. To find D5, I would take D4, so n is 4, D4 times 1 plus 0.05, because I said it was going to be 0.05 after the 4 years, divided by RS minus 0.05, because I said it's going to be 0.05 after 4 years. Then I would take that whole number, divide it by 1 plus RS raised to the 4, because n is equal to 4. And I'd work that out, and that would give me the value of the stock. Now, one of the things to kind of keep in mind for this is, what that means is you can actually have a growth rate that is higher than RS during this period. So in other words, during the initial period, the growth rate can exceed RS without causing a problem for the model. As long as the growth rate that we have that lasts for all eternity, the GC in this formula, as long as that growth rate is less than the RS, the formula will work. So in other words, what we have is sort of some kind of initial growth that's occurring for n years, however long. In my example, it was 4 years. Then it stabilizes at a constant rate thereafter. And as long as the required rate of return is greater than that rate of growth at which it stabilizes for all time, then this formula will work, and you can use this model. All right. At this point, you should actually probably try some examples and kind of see if you can work that out and see if it makes sense to you. All right. Thank you so much for watching, and have a great day.